Brad Williams, Frugal Finance. More on swaptions, a corporate application of a swaption. Swaptions offer the same kind of speculative and hedging opportunities as all other options. As an example, consider a firm that has issued a callable bond. From the perspective of the issuer, we may analyze a bond with a call provision as consisting of a non-callable bond plus the purchase of a call option on the bond. From the issuing firm's point of view, the firm has paid for the option by promising a higher coupon for the callable bond than the rate necessary for a non-callable bond. We assume that the first call date for this bond lies in the future, and the firm has decided that it will not want to call the bond because the firm anticipates a continuing need for funds and does not particularly wish to incur the transaction costs of calling the bond and going through the registration process to issue another bond to meet its financing requirements. Having made the determination, the call features of the bond represent an unwanted option in the firm's portfolio that will be losing value through time decay as expirations approach. Yet, the call provision has a real value. The firm's problem is to find a way to capture the value of the call provision without actually calling the bond. To capture the value of the call provision, the firm could sell a receiver swaption with terms that match the call features of the bond. In effect, the transaction would unwind the call feature inherent in the original bond because the firm receives a swaption premium that equals the value of the call provision on the firm's bond. We're going to exchange one for another. For the firm in this situation, consider the following data. The call date is 1 year away. The semi-annual coupon rate on the bond is 9%. The principal amount of the bond issue is $150 million, and present maturity of the bond is 7 years. To implement its strategy, the firm sells a European receiver swaption with an expiration of 1 year. The swap that underlies the swaption has a tenure of 6 years, a notional principal of $150 million, calls for semi-annual payments, a fixed rate of 9%, and a floating rate equal to SOFR. The price of this swaption depends on the current fixed swap rates relative to the terms specified for the swap underlying the swaption. The lower rates are today when the firm sells the swaption, the greater is the value of the call provision on the bond, and the greater is the value of the swaption that the firm sells. After selling the swaption premium belongs to the firm, but the firm has potential obligations in 1 year. At expiration, the holder of this receiver option will make its exercise decision depending on previous market rates for this kind of swap. At expiration, if the fixed rate for this kind of swap is above the fixed rate specified in the swap agreement, say 11%, the owner of the swaption will not exercise, because exercising and the swaption will expire worthless. The swaption holder will not exercise because exercising entails entering swap to receive a fixed rate of 9% and pay SOFR when it could simply go to the market and enter an analogous swap to receive a fixed rate of 11% and pay SOFR. In this case, the obligation of the firm is extinguished without performance, and the firm has simply gained the swaption premium. Note also that with current fixed interest rates of 11%, the firm has no incentive to call its bond. By contrast, if market interest rates at expiration are lower than the current rate specified for the swap underlying the swaption, say 7%, the owner of the swaption will exercise. By exercising, the owner of the swaption can enter a swap to receive a fixed interest rate of 9% and pay SOFR at a time when the market only offers a rate of 7% in exchange for SOFR. If the swaption is exercised against the firm, it will be obligated to make a sequence of interest payments at 9% and to receive SOFR. In this situation, the firm will also call its bond because market rates are at 7% and the coupon rate on its bond is 9%. The firm then might issue a floating rate note for its financing needs. Assuming that it issues a floating rate note at SOFR for a term of 6 years to match the tenure of the swap, the firm's cash flow for the life of the swap are as follows. Swap, pay 9% fixed rate on 150 million notional principal, receive SOFR on 150 million notional. Debt financing, issue 150 million floating notes with a maturity of 6 years at SOFR. Use the proceeds of the 150 million floating rate note to call the existing bond and repay the 150 million principal. Netting out the receipt and payment of SOFR and the call and financing of the original bond, the firm's net position is to continue paying the fixed rate of 9%, equal to the coupon rate on its original bond. However, the firm has captured the value of its call provision by the receipt of the swaption premium. Brad Williams, Frugal Finance. See you soon.